What is an inverted yield curve and why does it matter for us?
Yeah, we got this question, from the client, so we created a little visual here, and let me show you what that looks like. So the yield curve is normally, if you look at that green thing, it kind of curves this way, and what it's showing is that, the yield or that what the bond, in this case, treasury bond is what we're usually talking about, what the bond pays, right? What's the people want to call it the interest, but there's what the bond pays, and so the number of years that you go out, normally you get paid more. So you get paid more for a 30-year wait on a bond versus a 10, and you get paid more on a 10 than you do on a 2, and more on a 2 than you do on a 3 month, right? That's a normal yield curve, and that's that green thing that you see. But sometimes it gets inverted. Right now, you're getting paid more on a 2-year bond than you are on a 10-year bond. Let's think about that. So you don't have to wait for 10 years to get your return. You can get it more in a 2-year. And so that happens because people are worried about the future. And 10-year bonds tend to kind of follow what that worry is. And so that is becoming softer, which, in terms of the yield. And then we're seeing a bigger yield on the 2-year because they're expecting a higher interest rates in the short term, which seems like a good expectation. The Federal Reserve has certainly broadcast that they're going to raise rates some more before they get to their top bracket.
So does the I guess consumer buying demand kind of set these yields in a sense. So there's a less demand for the further out yields, so that's why they have to come down or they have to come down to kind of
Yeah,
accommodate.
it's a market mechanism, right? I mean, there's supply and demand, and so when you see an inverted yield curve, you are seeing concern about the future. That's how we look at it. I mean, and again, why does it matter? Because it precedes some big recessions. This is only going back, to 2000, but you can see, the out to the left there, we had that, drop below the line there. The line is zero, which just means that their 10-year and the 2-year were equal. But and when it gets below, that means the 2-year is paying more. That preceded the 2000 recession. It preceded the 2008 recession. They can be kind of early. If you look close at that, it can be, quite a bit early. You have to be patient and wait for these things, as far as that goes. But where we are right now, we're actually quite inverted. Although one thing the studies show, the New York Fed did a really great study on yield inversions, and it's not the severity, it's not how much it's inverted, it's the length of time that matters. So you could have a very light inversion. Matter of fact, if you look at 2008, that's a fairly light inversion, but a pretty big recession that happened. So it's more the length of time. So like a 3-month inversion is, considered more indicative of a downturn in the economy than a 1-month deep inversion, if that makes sense. So, we're inverted since the beginning of July, so we're heading into that 3-month area as we speak. So, that's why it's important. It's why it's actually in all the different baskets of leading economic indicators. This is one piece you'll find in all of the ones that I've seen is the inverted yield curve. And honestly, it's one of the ones. If you just wanted to follow one thing, it's not a bad thing to follow. But again, there's a fear of what's happening in the future, that there might be a recession, and so that inverts that yield curve. And then, contrary to that, you also need to see that reverse to the other direction, oftentimes, to see the market start to recover. And that's what this David Rosenthal said today on CNBC. Never had a bear market hit a bottom point during a yield curve inversion combined with the Federal Reserve raising rates in the history of bear markets. Could happen this time. That's obviously true, but it's less likely to happen. It hasn't happened in the past. And so people are calling the bottom and buying like mad and such, at the, September, and then it fell. And then they bought this week, and then it's falling. So they're kind of trying to buck that trend, right? And hoping for a pivot from the Federal Reserve that doesn't seem to be coming quite yet.